How is everyone doing? Welcome back to another episode of The Banker Next Door. I'm your host, Dr. Joe Berquist. Today, we're going to take a look at capital markets. So capital markets, they are ready and eager for banks to start raising money. Oh, yeah, they want those capital raises, baby. But the big question, though, is how should banks be using said capital? If it's great that a bank can go raise that money, but then once they've raised the money, how are they putting it to work? And it comes to a couple of things of what do investors want the bank to do with the money versus what the banks feel that they need to do with the money. So what we're going to do is we're going to take a look at an article here from Bank Director. And this article is titled, "Capital Markets Are Wide Open for Banks, Industry Observers Say." However, investment bankers at Bank Director's Bank Board Forum encourage the audience to raise capital, but investors favor certain reasons. So in other words, banks can have a lot of great reasons, as we're going to see here in a second as we go through this article, for wanting to raise capital, but investors really want that money to add to the bank's profitability, thus going to the bottom line. Whereas a lot of the investments that banks deem as very important or vital to the business strategy may not, go directly to the bottom line right away. It may take a little while. So that's kind of the balancing act of what you're looking at here. But anyway, let's get in here. So credit markets are open to banks needing capital for key strategic initiatives. Some banks may have previously paused plans to raise capital given market volatility and economic uncertainty earlier this year. The KBW Nasdaq Bank Index fell to a low in April, but has since recovered and is up about 20% for the year. Not too bad. The capital markets are wide open, said Brian Liebfried of Performance Trust Capital Advisors during a presentation at Bank Directors Bank Board Forum on Monday in Marco Island, Florida. As a board member, you need to be demanding a conversation around this with your management team. So demanding, it's an interesting word, demanding a conversation, not asking, demanding. This has been especially true for institutions looking to raise funds in conjunction with an acquisition. In 2024 and 2025, there were 9 deals that raised $2 billion in public equity, according to a presentation by Stephens during the conference. The Bank Board Forum runs through Wednesday and covers a range of issues such as governance, compensation, M&A, and risk management. We have seen for the first time in a long time capital being raised concurrently with the M&A deal, says Frank Sorrentino, a managing director at Stephens. We haven't really seen this since the 2018 timeframe by our tracking. So it's been about 7 years. Of the banks that have announced capital raises, their stocks have reacted very, very well, Sorrentino noted. For instance, Kansas City, Missouri-based UMB Financial Corp closed its roughly $2 billion all-stock deal to buy Denver, Colorado-based Heartland Financial USA in January of 2025. It raised $242 million as part of the deal, according to Stephens. Since the end of April 2024, when that offering was priced, UMB's stock price has risen by roughly 50%. You are going to see more of this for sure, Sorrentino said of banks looking to raise capital to complete a deal. That prediction comes as M&A has picked up this year. So far, 101 deals have been announced through August 6th, according to Liebfried's presentation. That's on track to be the best year since 2021. Given his prediction that there will be 170 deals in 2025 on an annualized basis, last year, by comparison, there were 126 deals announced, and in 2023, there were only 96, according to S&P Global Market Intelligence. Still, banks need a reason for their capital raise, said Dan Flaherty, managing director of the Financial Institutions Group at Janney Montgomery Scott. They want something behind it. The markets aren't so open just yet where we could go out and just raise capital for raising capital's sake like we did in 16, 17, and 18. Specifically, investors are also looking for how the capital raise will boost the bank's profitability. For instance, when money has been raised in connection with an acquisition, the deal would boost the acquirer's bottom line, as opposed to being needed to fix the seller's credit quality. Or banks have raised money to sell underwater securities in their portfolios. Though there may be an immediate hit, the banks have been able to demonstrate how the move will improve earnings the following year. Investors prefer these types of scenarios for capital raises. In contrast, it's difficult to ask investors to fill a hole, Flaherty said. This even goes for technology, which can be essential for banks to invest in. Banks are better served by paying for these projects through organic capital accretion rather than going to the capital markets. I mean, community banks, smaller banks definitely are always trying to play catch up on technology ads. It's not very exciting to raise 20 million and allocate 5 million of it to new software. Right now, with much optimism in the industry, banks may have no shortage of strategic initiatives that they may want to pursue. Exactly. Flaherty noted that banks over the last few years have been waiting for a number of events, such as the liquidity crisis in the spring of 2023, to subside and interest rates to normalize or even decline. Now that the industry is past that, the credit quality remains strong. He encouraged banks to be ready to seize any opportunities since windows come and go. I would encourage you to go back to your board and tell them that you heard things like this, because I think it's a good time to do things, Flaherty added during a panel discussing strategic capital considerations during the bank board forum. I think first movers always do the best. I think in 2026, banks will flip from defense to offense, he added. I think you can really add a lot of value to your franchise over the next couple of years. Yes, I totally concur with the thoughts here in this article. Now, so what they're saying here is that, capital markets are over. Capital markets are open. They really want banks to go out and raise money, but they would really like banks to raise money to go buy other banks. They would really like them to raise money for M&A, and the M&A market is really starting to pick up traction for the first time in a number of years, which is fantastic. You love to see it. And I think from a regulatory perspective, regulations are also playing in nicely to this. So you have kind of not, and again, I keep saying this time and time again, this is what we're seeing right now is not a deregulatory environment. It's just, we are just going back to normal. We had an environment here for 4 years under the Biden administration where things were just not normal. M&A transactions were being dragged out to 2.5 on the extreme end, sometimes even 3 years potentially, and that is just way too long. A normal M&A transaction should take somewhere between a year to a year and a half from start to finish to get completed, and then you get a couple of years to earn your money back on that deal. That's a typical M&A transaction, and that's all that's happening right now is we're just going back to normal, which is fantastic. And part of that going back to normal is what also is helping the capital markets to open back up and say, hey, we're starting to see a good time to do a lot of M&A. So, but at the same time, banks also have a lot of needs. One of the things they mentioned in here was the fact that some banks out there need to reposition their bond portfolios because they have a lot of what's called unrealized potential losses in their bond portfolio. So a lot of them have decided, hey, you know what? We just need to take the hit, sell these securities at a loss, but in order to plug that hole, so to speak, one of the strategies to do that might need to raise capital. Other banks have also looked at selling insurance units or doing what's called sale leasebacks on their, selling their branches to someone else, but, staying in the branch, but just leasing it back after you sold it to raise the money to cover the repositioning of the bond portfolio. So in other words, you have to, if you're going to take that hit, you got to find a way to cover it, right? So one of the ways that they're potentially doing that is through a capital raise. So a lot of this, I think, really comes down to bank management and how they are able to paint this. Like, in other words, there are a lot, particularly small banks, banks under $5 billion in assets. They have a lot of pressing needs, particularly around technology. If you want to stay competitive, you want to hang with your competitors, you have to continuously reinvest in, and it's all different types of technology, right? It's not just one particular thing. I mean, it's hardware and software. It's working with different vendors, but it's also your networks. It's cybersecurity. A lot of different aspects to this. It's not just one particular thing, and banks have a lot of needs across that board. And while the article says in here that, like, hey, look, it's not very exciting to raise 20 million and allocate 5 million of it to new software. Yeah, that's true. It's not very exciting, but it may also be absolutely essential. It may be absolutely essential. Like, in other words, if a bank might be saying, you know what, we want to do that acquisition. Like, in other words, maybe we might be around $2 billion in asset size, and we want to do that acquisition that's going to take us closer to 10 billion. But before we could do that, we have to be in a position to be able to absorb the bank that we buy, which means we need to upgrade all this stuff. We need to upgrade our core system. We need to upgrade all these other things that we're doing first, so that we have everything in place and that we're ready to then go out and do that M&A transaction. Now, but again, a lot of it comes down to how is the bank management team, how are they painting this picture? How are they selling this, as it were, to the potential investors during that capital raise? How are they, doing the dog and pony show, so to speak? So, but again, I think this is really interesting. It's great stuff. Capital markets are open. Great. We're walking into a great time, and you love to see the enthusiasm. That this. I think that banks could add a lot of value to your franchise over the next couple of years, and that basically 2026 could be a year of switching from defense to offense in the banking business. Which is, again, I think that, and I love to hear it, love to see it. So, but anyway, all right, I will wrap up this episode by saying, if you like this episode, please make sure to like, share, and subscribe. That always helps the channel. Remember, we are on YouTube, Rumble, and all major podcast platforms. Please be sure to leave your comments down below, as I always love getting back to everybody. And as always, make sure to check out some of the other content on the channel. So I thank everyone for listening. Have a great day out there, and I will see everyone again real soon. Thanks a lot.